not growing that fast. We're getting increased productivity. So the way you broke that down, the math, that makes a lot of sense for how GDP growth could be in the ones all the time, because that's how the population's growing. And then you add on a little bit more for increased productivity, but it's not going to be like, some of these countries where they're printing out, these, huge figures like China, which who knows what those are even about, because I don't think they have much population growth, but somehow they're just
right. Right. Yeah. So, and then the only thing that's going to increase it over that kind of baseline level is if you find some way to add workers in, right? So it could be immigration, could be a change in the participation rate for labor, which doesn't seem likely for us. And immigration's been down for us as well. And then obviously if the unemployment rate is high, cyclically, like if you have a recession, unemployment rate goes to 10 or something, then as the economy turns back to growth and you start pulling those people back in and working your unemployment rate down, then you'll have growth rates in the 3s and 4s until you get back to that low kind of full employment level. But that's really the only way mathematically for that to happen. And when people talk about rates in the 70s, it's like, okay, well, what else was going on in the 70s? You had the most incredible population boom in the history of mankind, relative to what the existing population was when those baby boomers came through. It was just insane. And, labor force growing at, 3% a year, 4% a year, and outpacing the economy's ability to supply the goods and services for it. So you just had this relentless inflation because you have people that are, starting their lives, getting new jobs, buying houses, doing all that stuff. Bank credits expanding, credit cards came to be pretty big during that time period. So all of those things were, a lot of inelastic demand from those people because they don't when you're 24 years old and you buy a new house, you just need the couch. You're not going to be like, oh, darn it, couches are expensive now, I better not buy one. You're not going to sit on the floor, right?
Right.
You're going to buy the stuff you need. So, and that whole dynamic is just not around anymore. So to go back to that kind of growth and inflation, you'd have to, sell me on some reason why we could expect that to happen when you only have your workforce growing at 1% a year and everybody's kind of old now at this point. So, that's where I think people get a little bit lost, is that they just see a high inflation number and they say, let's comp that to what else do I know, right? Let me find my next comp. And your comp is the 70s. So you just assume that it's going to look like that when the fundamental reasons for it are just so different, right? You had that fundamental growth story versus now where you just have the government taking a bunch of money and cramming it in there. So you get this one-time shot where everybody's got a bunch of money that they're trying to spend and the economy can't, support it all or supply all the stuff they want. But as soon as that money goes away, there's no more people being born. There's no more massive, growth in the workforce. So where's that demand going to come from? It basically just got pulled forward, not, created in a sustainable way.
Thanks for joining us on the Rise and Invest podcast. Please be sure to hit that subscribe button on YouTube or wherever you enjoy your podcasts. If you'd like to dive even deeper into real estate investing, check out our company's website, riseinvest.com. If you are an accredited investor, you can get started today as a passive investor in our multifamily investment opportunities by hitting the Invest Now button on our website.
The views and opinions expressed in this podcast are those of Drew Breneman and guests as of the date of recording and do not purport to reflect the views or opinions of Rise Invest Holdings LLC and its subsidiaries. The views and opinions are provided for informational purposes only and should not be relied upon or deemed as investment or tax advice or an offer to buy or sell securities, and the speaker cannot be held responsible for any direct or incidental loss incurred by applying any of the information offered.